Hello, welcome to Lecture 15 of the Fiat Standard online course. Today's lecture's topic is Bitcoin banking. So, in the first part of the book, we looked at how fiat money emerged. In the second part of the book, we looked at the consequences of fiat money. And in the third part of the book, we explained why Bitcoin can be the solution to the problem that is fiat money. In the first chapter of the third part, chapter 13, we explained why Bitcoin fixes this. In chapter 14, we explained how Bitcoin can scale to fix this, and we discussed different scaling solutions and the trade-offs involved. And in this chapter, chapter 15, we try and complement the picture more by looking at the economics of a banking system based on a Bitcoin standard. And this is a question that comes up very often, and it's a question that a lot of people come up with as a response to reading the Bitcoin standard, which is, all right, so you make the case for why it is better money, but how will a banking system work with a fixed money supply? So here in this chapter, I try and think about what the implications of banking in a Bitcoin world would be. So to begin with, we start from the idea that banking has two core functions. Banking really does two things. First, at its core, there are two things that a banker can do for you. They can hold your money, in which case they keep it safe, available for you, so that you don't have to worry about having to store it yourself. Or they can allocate investments. That's the second main core function of banking, which is that they can take your money and put it into a productive business so that that business could then earn you a return that increases the amount of money that you have. Those are the two things that banking as a job can do. And this is just perfectly normal market service offered by people in societies all over the world. It's something that has evolved throughout history and has evolved mostly, of course, and become much more sophisticated under a capitalist economic system. And the reason for this is that specialization in these functions increases their productivity. Just like with anything, people, when they focus on doing something, they become very good at it, and so they're able to provide it with a higher level of productivity for other people. So to begin with the first one, the issue of custody or deposit banking is something that can very obviously benefit from specialization. In the same way that any good benefits from specialization, you can very easily see why keeping money safe is useful for people who are thinking about what to do with their money. Keeping it safe is a useful professional good to provide for them. And so, your home is optimized and it's designed for all kinds of things. It's optimized for comfort, for convenience, for having a nice view, for being in a nice neighborhood, for getting a lot of guests in and out into your house. It's not optimized for keeping things safe. There is, if the main goal of your house was to keep your money safe, you would design your house very differently. You'd design it more like a bank headquarter, or a bank vault. And that's obviously not very livable. Nobody wants to live in a bank vault with no windows. So therefore, we get this as a market good where somebody specializes in providing it. They build a vault that is the safest place in the town, and they provide all the state-of-the-art in protection technology, from both the material that you build to the people that you employ in managing this thing. And therefore, you're able to offer people a place that is far safer than their homes. Then they don't have to worry about their money getting stolen if they leave their home. They don't have to worry about getting broken into their house, because it's much, much, much harder to go into that safe. So this is a normal kind of good on the market that has been provided, and you could expect it to be provided in any kind of context with any kind of money. I don't see why this would not exist in any kind of monetary system, because whatever kind of money exists, people are going to want to hold it, and there will be benefits from people who know how to hold it very well and very safely, providing that as a service. So this part of banking, I think, remains in Bitcoin. And, obviously this involves some trade-offs. If you keep your Bitcoin with somebody else, then your Bitcoin is not really censorship resistant or confiscation resistant. They can take your Bitcoin and they can stop you from using it. But arguably, you can still benefit from Bitcoin's monetary properties, as long as not everybody leaves all of their Bitcoin with a few custodians. And as long as we continue to have a rich ecosystem of independent nodes that own Bitcoin and transact on-chain with the Bitcoin, as long as we have that going, then the monetary policy for Bitcoin remains intact, and you are able to benefit from that monetary policy even if you keep your Bitcoins with somebody else. And so demand for resisting inflation is infinitely larger than demand for censorship-resistant transactions. In other words, as long as governments control money, the vast majority of transactions people want to do will likely remain for legal things. They want to buy food and regular consumption goods and trade. And only a small number of people want to do transactions that the government objects to. Of course, this only holds for as long as Bitcoin transactions themselves are not considered banned or not considered illegal. If they are illegal, then demand for all uses for Bitcoin becomes equal to censorship resistance demand. But currently, saving in Bitcoin is perfectly legal in most of the world, and so therefore you're not doing anything against your government's wishes when you carry out a Bitcoin transaction. And so if that continues to be the case, and if Bitcoin continues to be decentralized enough that the monetary policy survives, I still think we would likely still find a world in which there's a significant amount of custody of Bitcoin. I don't think it's, as I explained in the previous chapter, as with the transactions, even if there's a large amount of Bitcoin held in custody, the fact that people can take it out and settle it themselves, and the fact that they can withdraw it at any time, because of the fact that Bitcoin has 500,000 transactions on chain every day, means that there's a lot less wiggle room for people in charge of these banks in engaging in fiat, basically. So it's arguably possible, I think, that in a world in which Bitcoin continues to grow, that we'd have a large amount of Bitcoin in custody without it compromising Bitcoin's security model. I think there's just naturally going to be a decentralization of coin holdings. Even with a large amount of custody, there will still be, I think, a strong impetus for people to be competitive in their custody, in that they need to offer guarantees to clients that they are not going to engage in bad things during their custody of the money, that they're not going to inflate the money supply, they're not going to make more Bitcoin liabilities than they have Bitcoin on hand. It's much easier to enforce in Bitcoin because you can take your coins out at any time, and because it's relatively cheap to take your coins out. So because of that, I think we'll likely see a continuation of custody in Bitcoin. And I don't think it is necessary that it would compromise Bitcoin's security model. I see the case for why it could, but I also expect that the freedom of transacting Bitcoin will ensure that providers of custody stay on their toes. And ones who try and play games will, I think, get burned very quickly.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, The Bitcoin Standard, The Fiat Standard, and Principles of Economics. And you can also get copies of Lynn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters, and Mexican billionaires Ricardo Salinas Pliego's new book, The Bitcoin Enlightenment. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesaifhouse.com, the SAIF house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. With fiat money constantly debasing, preserving your wealth isn't an option or luxury. It's a financial and moral imperative. If you're familiar with my work, you know the only financial advice I ever give is to buy and hold Bitcoin for the long term. This has never failed anyone. If you want to buy Bitcoin, I strongly recommend using Swan, a group of hardcore Bitcoiners laser focused on making Bitcoin easily accessible. While most scramble to react to each new crisis, Swan private clients are already positioned in the only monetary asset with absolute scarcity, Bitcoin. Swan Private partners with families and institutions who share a principled conviction in Bitcoin as the foundation for multi-generational wealth. With concierge service, deep expertise, and uncompromising security, the Swan team helps clients exit the crumbling fiat system and secure their future in sound money. Today, Swan Private serves more than 5,000 high net worth clients who have purchased more than $4.5 billion of Bitcoin and put it into cold storage. If you're ready to move beyond the false promises of fiat, start your long-term Bitcoin strategy at swan.com/saif, SAIF. So the second function of banking traditionally is the allocating of capital into investment. And this is really the specialization in the allocation of capital. It's allowing the owners of capital to focus on earning capital and allowing professionals to focus on managing that capital and allocating it to places where it can produce the best returns given the investment goals of the owner of the capital. So by delegating it to professionals, they're able to assess your situation in terms of your financial planning, how old you are, what kind of risk you want to take, what kind of time horizon do you have for your investment. And they can match that with the correct business that is looking for capital from investors like you. And by doing that, allow a matching between the requirements from this investment for the investor and the company in which they are investing. And by doing this job well, by giving the capital to good companies, the bank would be able to profit because it takes a cut from the money that it makes for its client. So this is basically how the model works for investment, and it can be done in 2 ways. It can be done in a way focused on equity, or it can be done in a way that is based around credit. And of course, in the current world, it's predominantly built around credit because that's how the world works in the fiat world, because as we discussed in the earlier chapters. But I think in a Bitcoin world, it's going to be different. I think it's going to be equity based, and we're going to discuss why in this chapter. In fact, this is kind of the punchline of this chapter is to arrive at the argument for equities as a base for a Bitcoin financial system, for equity-based investment rather than credit-based investment, rather than interest-based lending. So the allocation of capital is, I should add, it's also it's something of human judgment. It's entrepreneurship. It's not something that can be automated. It's not something that is that Bitcoin can perform. We can just add as a smart contract into Bitcoin, so that your Bitcoin will just be invested and make a return for you. Somebody needs to look at the business and allocate the capital to that business. And there's an element of human judgment there that, you could delegate it to an algorithm, you could delegate it to a computer, but you have to be the one doing the delegation yourself. It's inescapably a human judgment, because ultimately you are taking your money and handing it over to somebody else. So you are making the choice in the person in which you're investing.
So I believe these two functions of banking will remain under Bitcoin standard, but they will likely look very different from today. So let's see why. Let's think about it in terms of a few topics. So first of all, we think of savings technology. One major part of this book, in the earlier part of the book, was to discuss fiat and the evolution of saving. And we discussed in chapter 3, I think it was, no, chapter 4, I think, on universal debt slavery, on why the fiat system is built so that everybody accumulates debt all the time. So we look at the history of savings. Historically, we see people used to just save in a gold coin. Then they would save in a gold or bank saving account where you held your money in the bank. And then when the money was no longer backed by gold, then your money wouldn't hold on to value in the bank. It would lose value over time. And so then interest rates, had to compensate for this. So the idea is that if you put your money in the bank, then your interest on the savings will exceed the inflation rate. And somehow then we can all have a free lunch. That's the Keynesian free lunch. That the government gets to spend everything that it wants and everybody is protected from inflation. And all we have to do is just let the banks take everybody's savings and invest them while keeping them on demand for the depositors. And, it'll work out because nobody will notice. That's kind of what it sounded like initially. But then, of course, inflation kept on getting worse and interest rates kept on going lower. And so, of course, this became increasingly unsustainable over time. And so in order to actually protect your money, you had to get out of your checking account and get your money out of a saving account and put it in government bonds. And so government bonds now became the saving account, because you can get a higher interest rate on a government bond than you can from your bank. And because, government bonds are viewed as being relatively safe. And because, government bond, when you buy a government bond, you're essentially lending the government money. And so you're allowing them and the banking system to create new money. So everybody involved in this benefits at the expense of everybody else, of course, the users of the money. So there's a huge incentive to get in on bonds to beat inflation. And it worked for a while initially, but then, of course, like all Ponzi schemes, diminishing returns set in and then it stops working. And at this point, if you're buying bonds, you're just volunteering wealth to governments. You get close to negative returns in some places, and negative nominal returns. And even if you get real nominal returns that are positive, most of the time they're almost always higher than inflation. If you want to measure inflation in the kind of vector way in which we discussed earlier in the book, my preferred metric, look at the price of the house that you want to live in and look at what has happened to its price over the last 10 years. That's the inflation that you've had to contend with over the last 10 years. So over time, that stopped working as well. So government bonds don't work. And now, starting in the 1990s or so, the stock market index becomes the new saving account. And so now, how do you save your money? You just buy an index of stocks, and then you don't have to worry about picking stocks and figuring out which new widget company is going to make the best widget. You just buy all the widget companies, and then the index picks the best companies, and the best performing ones get into the index, and the worst ones get taken out. And you're constantly basically guaranteed to beat inflation, or so was the pitch. But then, of course, that stopped working as well. Now that does not even really beat inflation. So you're taking on equity risk, and you're still not beating inflation. And so at this point, I think we've kind of reached the end of the line in that nothing's really working. Stocks don't beat inflation, bonds don't beat inflation. And stocks involve a lot of risk, obviously. And then there's real estate and gold and art. People have to also make do with those things. And so savings become an extremely complex problem for most people, because with savings, you need to manage your portfolio between bonds, stocks, your fiat saving account, your fiat checking account, your real estate, and your physical gold, and sometimes your art. And so all of these things need to be managed just so that you can save wealth into the future, which is insane. In the 19th century, we had solved this problem where everybody just saved their wealth in gold and bought consumer goods. Everything else was a consumer good. You bought a house if you wanted it. You bought a horse if you needed it. You bought a carriage if you wanted it. And you didn't think of those things as being your way of saving for the future. You just bought those things if you wanted them. And then if you wanted to make a bigger return on your investments into the future, you would invest. If you wanted to make more money, you would take on risk and you would invest. But saving was just very simply available for everybody by just holding on to the gold coin. Now, you need to spend years learning finance and the basics of how money markets work in order to just try and maybe have a chance at not losing a lot of your wealth every year. So this is kind of a short, concise history of saving over the past few decades. And so fiat man has to combine many assets as cash, depending on his needs for saleability across time, space, and scales. So if you are looking for saving into the future, you hold on to gold, real estate, and bonds, for instance. But if you're looking to move money across space, you want to pay for your groceries and you want to pay for buying things from abroad or whatever, then you need money in your bank account in your local fiat currency. And then if you have major expenditures, or if you have large sums of money, then you can't just save it in these smaller things, like where you would keep your running fiat expenses. You would have to buy something bigger, like a house or a piece of land, and then at smaller scales you buy gold, for instance. So you have all of these problems where you're trying to optimize, what do I do with this money and how do I distribute it among all of these different forms of cash. And it's a very complicated problem for individuals and businesses as well, particularly when you throw in the sophistication of having many fiat currencies. So you need to decide how many dollars you have, how many euros you have, how many of your local currency you have, plus how much gold, how much real estate, how much land, and how much bonds, how much stocks, all of that to be able to save for the future. It's a never-ending calculation problem, whereas under gold it was just gold. Under Bitcoin, it can be just Bitcoin, because Bitcoin offers great stability across time and space. So this is one way of thinking about it, that Bitcoin fixes the saving problem that was created with the creation of fiat. And then now if we think that Bitcoin fixes the savings and allows people to go back to saving, well, what's that going to do to people's demand for saving? Well, let's think now. If people are using stocks as money, in other words, people are buying stocks to save money rather than buying it in order to take risk on a company and make a return. If people are buying index investing in stocks, that's kind of using stocks as money. If people who don't follow what is actually going on with the company are just putting in their money in random companies because they need to get in on stocks, then you're using stocks as money. You're just using it as a way of saving, and you're only using it as money because your money is broken. But if you start buying stocks as money rather than buying stocks for their earnings, if they start buying them as a monetary good, as a way of saving, that increases the price of stocks and therefore makes them less attractive next to their earnings. So eventually, there comes a point where stocks don't justify the valuations, because at the end of the day, the stock of Coca-Cola is dependent on just how many bottles of their sugary sludge they can shift. So if people aren't buying their poison, then they aren't making revenues, and then the stockholders don't get revenues on the companies, don't get dividends on their shares, and so therefore the company becomes overvalued. So there's a limit to how much money you can pump into stocks as a way, as a mechanism of saving, because eventually you take valuations of the companies higher than what the fundamentals suggest. Same is true with bonds. And of course, what that does is then it creates a stock market bubble where people keep outbidding each other for stocks. And that's really how the business cycle happens. Because the fake money is circulating around, people are looking for a way to store that money. They start bidding up assets. You get a bubble in the asset. And now people are bidding it up because it keeps going up. They think it's going to keep going up. And then they keep bidding more and more. And then, of course, you get an oversupply of the assets. So people start making more companies, more stocks, and they issue more stocks. And eventually the oversupply overtakes the increase in demand, and then the whole thing comes crashing down. That happens because there is a fundamental revenue model for the valuation of stocks around which stocks can't differ too much. Same is true with bonds. You get a bond bubble because as people start buying more bonds, you start basically buying and lending to governments far beyond their, and to corporations as well. You start lending far beyond what their credit worthiness suggests. People are lending not because those companies and those countries and those governments are a good investment. They're giving them the money because the alternative, which is holding on to the money, is that it gets destroyed. So let's see if these people can destroy it a little bit less than how they destroy it with inflation if we just lend it to them. So again, that just leads to an enormous amount of lending by the government, which leads to this enormous amount of growth in government spending and government control over economic activity, which we see all over the world. Same is true in case of real estate and art. As they get used as money, more of it gets made and its value declines. People make more and more of it, so it doesn't really work as a good store of value. It's better than holding on to cash, yes, but it's not a good saving account. And that, of course, is because there's really, I mean, you can place limits on how much housing gets made through zoning laws and so on, but ultimately you can't. Demand will find a way, and they will keep making more and more housing. And the end result of trying to use housing as a saving account is that you end up with a large supply of houses that are being used as saving accounts that are not being lived in, and they waste away while a lot of people can't afford owning houses because the price of houses is very high, and that's kind of where the most of the world is at this point. But Bitcoin is different from those things because it has no yield. So because it has no yield, because as an asset it doesn't have a yield that gives it a fundamental value, which in the case of real estate is rent, and in the case of bonds is the coupon payment that governments make, and in the case of stocks it's the dividend that the companies pay. Because of these fundamentals around which the value of the asset oscillates, these assets can only hold on to so much saving before they become a bubble and then they crash. But Bitcoin is different because it has no yield. So the valuation, everybody's yield is already zero. So when more people buy Bitcoin, the yield doesn't go down. There is no yield. That's really the whole point. There is no yield on it. And so if your monetary asset has a yield, your monetary asset sucks as a monetary asset, because there's going to come a point at which the demand for the asset exceeds the valuation of the yield, and at that point the valuation of the asset is no longer justified. It can't continue to appreciate as a monetary medium if it is pegged to a yield, because that yield cannot continue to grow along with the growth in the demand. There's no reason why the sales for Coca-Cola will increase as much as demand for Coca-Cola stock increases. If there's no increase in sales for Coca-Cola, then an increase in demand for Coca-Cola stock as a saving account is not going to make Coca-Cola more profitable as a company. It's going to increase the valuation of the stock. It's going to allow existing stockholders to sell at a big profit, and it's going to be part of a bubble, which at some point is going to leave some bag holders holding stocks that are going to depreciate back down to the level where the earnings suggest. This is how it would work in a sane market. Obviously, currently the fiat system has just chosen to continue to boost everything with more and more money printing to try and keep this going. but you can't escape consequences forever. So Bitcoin also has higher salability across time, which means you can save wealth across time very well. It holds on to value because nobody can make more of it, nobody can debase it. So it's similar to gold in that regard. And it has higher salability across space, which means that anyone can withdraw on chain relatively cheaply and take custody of their asset at any point. And so it's much riskier to play fiat games, which stem from monopoly power over payment rails. So it's much riskier to do this. So the result then is that we're going to expect to see people have more and more savings. It's going to become more and more and more attractive for individuals and companies over time to hold Bitcoin as reserves. And we see this with the example of MicroStrategy and why they explain why they would hold it. And I quote them in this chapter to explain that.
This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently.
So as people continue to hold more and more assets, more and more cash in the form of Bitcoin, as opposed to all of the other assets that they like to hold is a form of saving, what happens? Well, as we were saying earlier, fiat in the fiat world, managing a savings portfolio is an endless task of weighing a multitude of risks against potential returns for an endless variety of markets. Well, all of these markets are distorted by monetary demand. The price of Coca-Cola stock is distorted by the fact that a lot of people are buying it because it's a way for them to save. It's a way for them to avoid inflation. But Bitcoin can basically demonetize everything and return it into being a consumer and or capital good. In other words, we go back into a world in which houses and the market for housing is purely about the role of a house as a good that people live in. People will stop thinking of their house as their saving account or their investment account. Their house will be just a good that they store, and the money that they want, that they own and that they consume. And it requires a running cost to keep your house running and operational. It requires maintenance, so you are consuming it. And your stocks, you would buy stocks in a company if you want to own the company because you want to take risk with your capital. If you want to be a risk taker with your capital and you have enough capital that you want to take part in the company because you understand this industry, you understand that it is a company that is likely to grow and you're willing to take the risk, then you will invest in it, and the value of the stocks will reflect the fundamental valuation. It won't just be, the stock market will not just be a reflection of monetary policy, which is what it is right now. And the market for credit, if it does continue to exist, would also be a free market in which, people will borrow based on their credit worthiness, not because everybody has a hot potato of money that they want to get rid of so that they can lend to the world, so that they can avoid inflation. And they lend to the world to avoid inflation. So Bitcoin can basically fix this. And I think perhaps the most significant issue here is the fact that it likely ends the bond market. If I'm to make a kind of bold prediction from this book, based on all of the analysis of Bitcoin and fiat in this book, based on the analysis of fiat as credit-based money, I think the rise of Bitcoin can end the bond market. It can end the entire idea of bonds as a financial instrument. I realize this is kind of controversial thing to say, and it's going to sound crazy for a lot of people, but I think there's a good case for why this is the case. The function of bonds in a portfolio is to preserve wealth while not incurring equity risk. This is why people buy bonds. It's meant as your conservative part of the portfolio. Is just your way of holding on to the money. And in the modern world, there's a huge incentive to get into bonds because they are credit creation. If you just hold on to cash, if you take custody of cash and you put it in your in your home, you're just holding on to a certain amount of money. But if you go and buy bonds, you're lending money to the government, and that allows the government and the bank to effectively create new money and bring in new money into the money supply. So that's something that they appreciate, so they can cut you in on the deal. And that's why buying bonds is much better than holding on to cash under your mattress. So that's why it's a huge incentive. So the fact that mining fiat is lending creates a huge incentive for people to get into lending, which is what bonds is. So if you take that incentive away, then you massively reduce the incentive for people to store their wealth in bonds. And effectively demonetizing fiat credit will take away the incentive for the creation of a lot of fiat credit. And when you think of that, then you can see why people would want to move away from holding bond and investing in holding on to a hard money. When you see the incentive for lending bonds as, because whenever you borrow, you're creating new fiat, you're devaluing the existing fiat. When you look at the incentive of it that way, you can see why the government bond market is arguably the largest malinvestment in history. There's never been this much human resources misallocated as the amount of capital, I think, that is in the hands of governments today. And it is there today because everybody who has money is having to buy bonds all over the world. And the reason for that, of course, is that there's the incentive because it's lending, but also, of course, issue is that the bond market is enormously liquid. So you can have large positions that you can enter and exit as a large financial institution and as an institution that holds positions for a large number of people. You need the kind of liquidity that the bond market allows you, where you can enter and exit into large positions without materially moving the market for that position, which is something that is difficult to do with small-sized companies. So currently we see that the return on bonds is going negative in nominal terms and also in real terms. Bitcoin offers better returns in nominal terms when it's a zero. Zero is better than negative. And of course, when you factor in the appreciation in real terms, in terms of real purchasing power, I think it's likely that this relationship is going to follow that same pattern in the long run. So one other reason why I think Bitcoin improves over the bond market as the ultimate store of value for the fiat system is that the bond market, even though it is enormously liquid and it's got it's got more than $100 trillion in it, these $100 trillion are bonds of different maturity for different institutions. So it's not all homogeneous. A 1-year treasury is different from a 10-year treasury, is different from a 2-year German bond, is different from a 5-year Coca-Cola bond. All of these are different kinds of bonds, and they're not fungible, and they all have their own markets. Of course, this is a massive inconvenience of the fiat barter system. In a real monetary system, you wouldn't need all of these things. You would just have money. Everybody would hold on to money, and you'd get the real return every year from holding on to money is just the appreciation of the money. And the other thing here is that in this situation, the Bitcoin liquidity is all in one asset, all in Bitcoin. It's all Satoshis. So one Satoshi equals to one Satoshi. So a bond market or a saving market that is run on Bitcoin Standard will have all of that wealth denominated in the same thing, Satoshis. So it's all interchangeable and it's all exchangeable for one another. And that's not the case in the bond market. So I think this is an enormous improvement. If we have, think about in all of the current bond market, if all of that wealth is stored in a hard money that appreciates 3% per year, then that's an enormously liquid money, and that performs the job of the most liquid market in the world, much better than the current bond market, which is the most liquid market because, as I said, the bond market is not fungible. Bonds are not the same. It's a highly fragmented market of millions of tiny little markets inside it. So I think without the enormous distortion of fiat and monopoly banking, it's unlikely a Bitcoin world would have bonds. I think people would just simply hold on to the money itself. And I don't see how you could sustainably run a bond system if you didn't have the ability to continue to inflate the currency and generate more currency and pay it off. That then, if you think of a world in which everybody's holding cash balances, present money, instead of holding credit, that just leads to a much more robust global financial system all around, because the current fiat monetary system has its building bricks made out of pipelines, to kind of butcher metaphors and make a Frankenstein of a metaphor. In a sense, everything is made out of credit. So the building blocks of the system are set up in a way in which everything is built on credit. And so if you get a problem of credit anywhere, then the entire system falls apart. In other words, if you get a problem with the piping, your walls fall apart. You can't just fix it with changing a pipe. The pipe is the infrastructure almost. And so the entire system is built on debt, and the entire system is built on fragility, on borrowing from the future. And of course, the more you borrow, the more you benefit, the more you enjoy it, the more you double down on it. And so everybody is borrowing and repaying successfully when market conditions are good, and the entire structure seems robust and fine. But then when somebody catches a cold, and when the good times end, and of course this is all monetary policy, so there has to be a point at which there's an inflationary monetary policy, and when that is discontinued and when that is reduced slightly, then the ensuing calamity is catastrophic for everyone, because the entire monetary system is falling apart in this case, and everybody's distressed, and everything is not working. Suddenly you can't pay for your lunch because your bank is out of business because they lent to some businessman who is overexposed. So with Bitcoin, on the other hand, the asset's value is not contingent on future cash flows and credit market conditions. It doesn't matter who can pay their debt. Your money is not dependent on other people fulfilling obligations for other people. The thing just works. It has its value in it, like gold. It doesn't have a cash flow. It's not contingent on anybody performing what they need to perform. So in a world in which we have high cash reserves, with no monetization of debt, no fractional reserve lending, market conditions become irrelevant to a financial institution's solvency. If you have your own money and you're not using credit as money, and you have, you're running a tight ship, then it doesn't matter what the rest of the world does. You have your own money, you have your own reserves, and you can meet all of your liabilities, and you have all of your house in order. Doesn't matter. That doesn't work in fiat. In fiat, no matter how tightly you run your ship, if any other ship starts leaking, all the ships start leaking. They're all connected to one another because they're all built into this system where everybody is reliant on everybody else's debt. So this is why I think it would be an enormously more robust monetary system. And I think the reason it would have full reserve banking, as I mentioned earlier, is that we can, when we tie all of those things together, we can see the ability of the bank to get away from full reserve banking as being a function of the degree of monopoly that this bank has with its clients' money. Think of processing payments as a market good. What banks do, moving money around, is a market good. The larger the market, the more there will be demand for payment processing. The more people want to move money around. With gold being expensive to move and verify, centralized payment processing becomes very valuable. If you have a monopoly on the ability of moving money around in a certain position, you effectively have a license to print money. So if you have a monopoly over clearance, you have a margin for expanding credit beyond your reserves, because money in the bank is more saleable across space than money outside the bank. There's effectively a premium to having the money in the bank, which prevents holders from cashing it all out at the same time. The higher the degree of monopoly, the more the bank can expand unbacked credit. And the more the bank can expand unbacked credit, the more money it effectively is creating out of thin air. And it can only get away with that because people can't just come and take all of their money at the same time. People have no choice but to use your bank if you're the only bank in town, or if you're the central bank of a country. They have no choice but to go through you. So they have to keep a big chunk of their reserves on hand with you, and they can't all withdraw it at the same time. In that situation, since they have no choice, they have no alternative, they can't just take it from you and put it to somebody else, you're always going to engage in fiat shenanigans, as I like to call them. You're going to find the reason why you can issue more liabilities than you have reserves on hand. But Bitcoin fixes this. So the way that I like to think of this is that the degree to which a bank can get away with fractional reserve banking is a positive function of the cost of the final settlement of the monetary asset. The more expensive it is to move a form of money around, the more reliant you are on a particular bank, the more the bank can get away with messing around with you. And it's also a function of the ease of debasing the monetary asset. The easier it is to make fake money and pass it off as real money, the easier it is to do fractional reserve banking. So in the situation of fiat money, you can do fractional reserve banking because the central bank can just make more fiat money to bail out any bank engaged in fractional reserve banking. So if you have a lender of last resort, that helps you have fractional reserve banking. That's the only reason, that's the only way you can sustainably have fractional reserve banking, which effectively really is almost like admitting defeat and not having fractional reserve banking. Because when you have a lender of last resort, you're effectively saying that the money is there, it's all there, it's only going to be printed in case there is a bank run where it is all needed. But even though the money is not printed, it is effectively there. It's the central bank stands ready to create the money if needed. So the more expensive it is to move the asset, the more likely it is for an individual to use that asset through the bank and have to rely on the bank, and therefore the more likely they are to leave it at the bank, and therefore the more likely the bank is to issue more liabilities for it than it has assets on hand. But of course this is not sustainable. The more safe the bank appears, the more it lends unbacked loans, the more risky it becomes. This is why there are many crises under the gold standard, and why the gold standard had to be abandoned for a monetary system that allowed governments to bail out banks from these crises. The problem of gold was that it did not allow governments to print it, to bail out banks, basically. And that's why it had to be replaced with something that is optimized for bailing out banks, which is fiat. So any system for Bitcoin settlement would be far more distributed at its core than gold, and the benefits from economies of scale are not as pronounced as with the case of gold. There is room for far more institutions to be able to perform settlement with one another. With higher spatial salability comes higher capacity for more transactions and therefore less unbacked liabilities. There's a far smaller ability for banks to issue unbacked liabilities when their asset can just be cashed out very easily and very quickly. So in conclusion, that's what leads me to think that Bitcoin financing will likely be far more equity-based than debt-based. Because A, if issuing debt is no longer mining money, that removes an enormous incentive to lend. Secondly, without a lender of last resort, fixed interest rate lending is highly risky for the lender. There's always risk of complete loss, so nobody can offer a fixed return. There's no lender of last resort to ensure banks can meet their obligations. And there's very high spatial salability, which means depositors can easily take custody and make the bank illiquid at any time. So without a lender of last resort, it's really difficult to see how you can have any kind of fixed interest rate at all, there's always a risk that the business could go to zero. So nobody can guarantee that you can offer a return. You can't tell people you're going to offer them 3% return and guarantee it, because not only will you not necessarily make 3%, but you could also lose all their money. Every business can lose everything. It could go to zero. Every investment can go to zero. It could suffer complete catastrophic loss. A meteor could hit, or a pandemic, or something bad happens, and an entire business and venture could be crossed out and go to zero. So there is always a risk of complete loss. And therefore, nobody can guarantee you a return in the form of money that they can't print. Because, if the business in which they've invested goes to zero, how are they going to get you how are they going to get you the money back? There's no way of guaranteeing it. So there's no lender of last resort to ensure that you can guarantee that. So therefore, if there's no lender of resort, there's no hiding the risk of credit and investment with Bitcoin. If you want a positive return, there is a chance of loss, including complete loss. So if you want safety, you can pay to have your money safely deposited and custodied. But without a lender of last resort, interest lending has limited upside and unlimited downside. That's really the issue. And I don't see it surviving in a market against equity investing, because equity investing has unlimited upside and unlimited downside. In other words, if you get into a contract where somebody offers you a fixed interest rate, a 3% return for a loan, and you're guaranteed because you're putting it at a bank and the bank is guaranteed by some authority, well, you're not guaranteed, because the bank could go to zero and the authority could go to zero, because nobody can print Bitcoin. Eventually they could all run out of Bitcoin. They could get robbed or hacked, or their business can go to zero, or that an earthquake could eat all of their business and all of their assets. It can happen. So if you take a limitation on the upside by accepting an interest rate, if you accept an interest rate like 3% or 5% or 10%, whatever it is, as your payment in case the business succeeds, but you are taking on the downside risk every single time, eventually that's not going to work out as well as the person who takes on the full upside and full downside risk. It's not going to work out as well as the person who is able to, they'll lose everything if they lose, but they will make a large return if they make a profit. And so therefore your upside is limited, but your downside is not limited. But their upside is unlimited and their downside is unlimited. In the long run, that's going to be a far more successful strategy in the market, I believe, than fixed interest rate lending, which cannot provide you protection. So those are the first two reasons. And now the third reason is because of the accumulation of cash balances. When you have an enormous amount of cash balances, because of everything that we've discussed earlier, people accumulating more and more cash, and cash holding on to its value, because of that, the need to chase yield is reduced. You don't need to chase yield and take risk with your cash, because your cash is appreciating anyway every year by the increases in the productivity of goods and services. If cash is abundant, then returns on lending it decline. So a lot of people have cash and there is an abundance of it, and so of course the price for lending it will decline. As capital is accumulated, interest rates decline, and that's basically human civilization. And then that's I think the way that I tie these things together is that ultimately, and I make this argument in more detail in my next book, the Principles of Economics textbook, as people accumulate more savings, the price that they're willing to accept for savings declines. In other words, the interest rate declines. And that's really the Austrian theory of interest rates is the Austrian theory of time preference. In other words, from the Austrian perspective, what sets interest rates is time preference. As people lower their time preference, they forego consumption and then they make some resources available, and then these resources, then they can lend it. They can lend these resources, and in order to lend the resources, they would need a financial incentive. They would need to be offered a reward for foregoing the consumption in order to receive a reward in the future. So in this case, as time preference declines, as people start prioritizing the present less and less, and as people start thinking of the future more and more, people start saving more, and so the interest rate declines. And that's why, for Austrian economists, the interest rate is the measure of civilization. The lower the interest rate, the more civilized the society is, because that society is foregoing a large amount of consumption and has an abundance of capital that means that this is a society that is very capable of delaying gratification. This is a society that is very good at disciplining itself, and therefore makes resources available in enormous quantities for its entrepreneurs and productive capitalists. And so therefore anybody who wants resources to engage in a productive business is able to get them at an increasingly lower rate the more civilized the society is, because more of them are available. On the other hand, societies that have higher time preference, like basically everywhere in the world today, they save less, and so therefore they make less and less capital available for entrepreneurs in order to invest. So historically, we can see that interest rates can be viewed as a reflection of the amount of saving and the time preference of a society. And as people accumulate more and more cash balances, the interest rates decline. And for the Austrian economists, Eugene Bomberg, an Austrian economist, said you can measure the moral and cultural level of society through its interest rates. And interest rates have been declining largely for the past 5,000 years. There have been a lot of interruptions, but historically we've got a trend of decline in interest rates over the last 5,000 years. The great study of this, which I mentioned in the book, by Homer and Silla. And in the early 20th century, the base interest rate for the Bank of England was around 2%. That was the lowest interest rate for anybody, which was the Bank of England. And it was offering 2%. 2% was the lowest interest rate. So that's basically, you could think of it as the pinnacle of human civilization when we managed to make our interest rate the lowest on the free market. That was the lowest interest rate. And fiat reversed this decline. When we moved on to fiat, the interest rates shot up during the 20th century enormously. And now they are low, but they are artificially low, and it's you can't really discuss them as real interest rates because they're heavily manipulated by central bank intervention and because the currency is broken. So we don't really have a free market in interest rate these days. My contention is that we have been in a 5,000 year process of civilization, and this 5,000 year process has been reflected in a declining interest rate. And my contention is that as gold became great money, and gold increased in its use as money, and it increased the productivity of society because of its excellence as a monetary medium, it helped us lower our time preference to the point where interest rates dropped to only 2%. And I believe if we had remained on the gold standard for several decades after that, I think interest rates would have been eliminated on the market. That nominal interest rate would have gone to 0%, and we would just not have interest-based lending. I think the end of fiat and a return to hard money with Bitcoin will likely resume this trend as interest rates continue to decline and cash balances increase. As 0% nominal interest rate is the only end point. As people's time preference continues to decline, they continue to discount the future less and less, and they will then accept a lower and lower interest rate to lend their money until eventually the interest rate hits 0% in nominal terms. And 0% in nominal terms still is positive interest in real terms if your money is hard. It's also positive interest in real terms because the cost of storing money and saving money is never zero. I think this is the key thing. If you just hold on to your money, you're incurring a cost. There's a cost to holding on to money. And that cost is greater than zero. And there's a risk of it getting stolen. So that cost is never zero. Every time you hold on to money, you're incurring a small little cost. And so if you are able to lend the money, getting the money back at 0% frees you from the storage cost and from the risk of loss and from the cost of insurance. So by lending your money out and putting it to work, you save on the cost of storing money. And if it's a hard money, you also benefit from the fact that the money appreciates. So if we say, let's hypothetically assume that the cost of storing money is 1%, and that there's like a 3% average increase in the prices of the goods that you, 3% decrease in the prices of goods that you buy in a year, because your own basket of goods, or the goods that you care about, hypothetically speaking, there's a 3% decline in their price every year because the value of your money goes up, because the money is scarcer than all of those goods. More of those goods are made, but no more money is made. So in that world, effectively, if you put your money under the mattress, you'd be earning a 2% appreciation per year, but you'd be paying a 1% storage fee. You'd be earning 3% appreciation and paying 1% storage fee, so you get a 2% appreciation per year. In real terms, you can buy 2% more things per year if that were the case. Well, if you lend it out, then you get a 3% appreciation every year, because at the end of the year you get the money back, and you don't have to pay the 1% to save the money. So this is how I think we end up with 0% nominal interest rates. Effectively, in a world in which you take away the incentive for people to create money through debt, and everybody accumulates more and more cash balances, and cash balances continue to grow, and you don't have a lender of last resort who's able to make the money for free and hand it out to people. You add those three things together, and I think we continue to witness interest rates decline until they hit 0% at a nominal rate. And when they hit 0% at a nominal rate, people won't be lending for business. People will simply be investing. And so why would I want to lend at a rate of 0% if I'm going to be taking the risk for a business? If I can see that lending at 0% would happen between friends, between family, people who need money. You can imagine a world like that where everybody has a lot of cash available. And so if somebody happens to get into hard times, all their friends and family have enormous amounts of money that they are happy to give them at 0% nominal rate. But if you have a business and somebody wants to borrow, and you want to borrow for your business, you can't isolate the people from the risk of the business. No matter how honest and hardworking you are, there is a risk that the business can go to zero. So I don't see why they would want to accept a low interest rate when they are accepting a very large downside. So I would imagine in this kind of world, you'd see a lot more equity investing. So I'll have a lot of money. If you have a lot of money, you'll invest in people rather than just lending them. So in such a world, we'd see banking separate neatly into two core functions: deposit banking, paid for by depositor fees, and equity investment, maturity matched, sharing in the upside and downside. That's basically how I see the function of banking. When you take out payment routing in the Lightning Network, which is discussed in the previous chapter, that leaves us with banks that storing money for people and getting paid to do it because they can't lend out the money while storing it for you in deposit, or making explicit equity investments where they take your money and they buy equity in a company with a matching maturity and sharing in the upside and in the downside. This is how I think of it. And yes, this is to a very large extent similar to the idea of Islamic economics. This is in essence what Islamic compliant economics discusses. And I've had 3 podcasts on the topic, one with Tariq al-Diwani, Safdar Alam, and Haris Irfan. 3 podcasts in the Bitcoin Standard podcast. You can check them out that discuss this issue in more detail. I think the parallels between Bitcoin and Islamic finance are a very fascinating topic of discussion. And that is it for this lecture. Thank you.